up right now. In fact, this just in on the gold market, the CME have raised the margins on gold futures. This is COMEX gold futures by more than 22% to $5,500 a contract from the $4,500 previously. Still, that hasn't done much to really cool down the ardor in the gold market, breaching 1,800. Some people talking about 2,000 as the next key target. The price of oil is looking strong as well. If you take Brent crude as the marker, up by more than 4%. There was a surprise drawdown in inventories, and that shored up the price dramatically. And NYMEX crude, a little bit of give back right now, down by 2%, in fact. Let's get more visibility on what's happening with commodities. John Kilger, founding partner at Again Capital, joins us live from our US headquarters. John, this action by the CME to try and shake out some of the perhaps speculative excess in the gold market doesn't really seem to have worked if you look at the initial reaction and the price.
No, not just yet. I just got the email myself moments ago as you were going on the air. I can tell you that there were rumors about this on the floor and throughout the trading community all day. And I would give it a little bit of time here to work its way through for everybody to understand the implications. Keep in mind, as much as this is an effort to shake out some of the speculation, it's also a methodology and a way for the clearinghouse to protect itself and its members, because obviously the volatility in this gold contract has been incredible, and this is just increasing the size of the down payment on the notional size of a contract that has just exploded.
Well, the margins for gold futures for speculators are now $5,500 per contract. That's up from $4,500 per contract. Practically, what does this mean when you take a look back at what we saw in oil markets when this type of measure was implemented by the CME? What do you think it could mean out there for traders, John?
I would expect some of the speculative length to certainly get wrung out. That's typically what we see. That's certainly part of this. It's a pretty big raise, and this is all leveraged money. And in the hedge fund world, you're judged on your metrics. So if you're up against your limit in terms of your margin usage against how much money is in your fund, and you get a hit like this, you automatically have to reduce your sizes to resize and get your margin ratio to your investment money ratio back in line. So this should engender some profit taking, some selling, outright selling, and probably get us back decently below $1,800 an ounce here.
So is $2,000 on gold less likely because of this move by the CME, John, or is it just a matter of when as opposed to if?
Yeah, I don't think this will be enough to stop gold dead in its tracks here at all. It may make the $2,500 call that you referenced a little tougher, but I do think the $2,000 number seems in line, and it's because of really what we're seeing, what you've been talking about, the concerns now over the large French banks and the rumors surrounding them, the concerns about France overall, and our own United States situation here. As well. I mean, we're going to have another nightmare scenario with this debt committee that's being formed. I mean, the Republicans have dug in with the 3 senators that they appointed to this committee. So that's going to cause more uncertainty, more unease in the market, and gold and the Swiss franc are just going to look like the place to hide out until the dust settles, if it does.
Yeah, a lot of strategists saying that they could see this appetite for gold continuing. But if we take a look at the technicals just for a moment, John, the relative strength index, for instance, was flashing overbought status at 84. Now, this is far above that level of 70 that many people watch for a signal of correction. Every time we've seen gold hit that 70 mark, it's pulled back this year. So are the technical charts flashing some warning signals for us?
Yeah, I think they've been signaling that, though, for a while here. I think you may see a corrective cleansing breath, if you will, but that, too, will be retaken. And I have to say, as someone who's been in this commodities especially, the RSIs can absolutely break your heart in terms of just day in and day out seeing defiance of them and continuing on the trend that we're in. Trends in commodity prices can be very, very compelling and awfully difficult to break. So even a slight pullback flattens out the steepness of many charts, as you may see here. But again, if we're looking for calls of 2,000 to 2,500 and higher into the end of the year, 4 months away, I think are quite reasonable.
John, what about crude oil? Is the bias still to the downside, despite the fact that we had this pretty sharp inventory drawdown?
I don't think so, not necessarily. On Monday night, in thin trading about this time, or a little bit later when we got the Chinese inflation data, crude really took it on the chin and got down to $75 a barrel here in the U.S., 75.17. And we've bounced now pretty strongly off it. And as you referenced the inventory report that came out here in the U.S. this morning that showed a decent decline. We have some pretty low levels now here in the U.S. of crude oil. We're also seeing continuing problems with the Brent North Sea production. That's been going on all year. And, of course, the Libyan situation has robbed us of quite a bit of oil. That is keeping the oil market a bit tight globally. So there's a floor into this. I believe that $75 is going to hold as the floor, even though we may retest that. I think that the growth in China is going to remain strong enough to keep the heat on in terms of tightness in the market and these prices being elevated.
Thanks for stopping by to talk with us and to give us some instant analysis on the CME move.